Imagine waking up and finding your investments cut in half. That's exactly what happened. Not once, but 10 times in history. These weren't just bad days. These were bloodbaths. Moments when the financial world cracked open. Entire economies crumbled. Fortunes vanished. And for a moment, everyone wondered if the system was broken for good. On this channel, we'll teach you the history of finance, the crashes, bubbles, the recoveries, and keep you updated with the most important news shaping markets today. So if you want to become the smartest investor in the room, subscribe to the channel and smash that like button. Now, let us dive into the 10 worst stock market crashes in history and what they still teach us today. Let's begin with the grandest collapse of all. In the 1920s, Wall Street was the heartbeat of American ambition. Stocks were booming. Millionaires were minted daily. And everyone, from barbers to bankers, believed the party would never end. But on October 29, 1929, the music stopped. It started slowly, a dip, then a slide, then panic. Over 2 days, the stock market lost nearly a quarter of its value. But the real damage was still to come. By 1932, the market had fallen a staggering 89%. Let that sink in. 9 out of $10, gone. People lost homes, jobs, dignity, banks collapsed. Breadlines stretched across cities. This wasn't just a market crash, it was the beginning of the Great Depression. It would take 25 years for the market to return to its pre-crash levels. Fast forward to 1987. The world is slick with finance, computers, hedge funds, a globalizing economy. The Dow Jones had surged over 40% that year. Then came October 19th. Without warning, the market fell hard. The Dow plunged 22.6% in a single day, the worst one-day percentage loss in history. Billions were erased in hours. What caused it? Part fear, part overvaluation, and part computer-driven trading programs that kept selling the more the market dropped. It was chaos, amplified by technology. But unlike 1929, this time the recovery came quickly. The damage was sharp but short. Still, it proved that markets could collapse faster than ever before. Now let's rewind to the dot-com era. The internet was new, exciting, and full of promise. Investors poured money into tech startups, many of which had never turned a profit, or even made a product. By 2000, the bubble was enormous, and then it burst. Over the next 2 years, the Nasdaq lost 78% of its value. Names like Pets.com and Webvan became punchlines. Even Amazon lost 90% of its market cap. The dream of the internet didn't die, but the illusion that every .com would be a gold mine was shattered. In 2008, we didn't just get a crash, we got a full-blown financial crisis. It started with the U.S. housing market, once seen as bulletproof. But years of reckless lending, complex derivatives, and blind greed had turned it into a time bomb. When housing prices fell, the system buckled. Lehman Brothers, a 158-year-old bank, collapsed. Credit markets froze. The S&P 500 lost more than half its value. Global markets followed. Trillions were wiped out. People lost homes, pensions, futures. The recovery took years, and it changed finance forever. Regulations tightened. Central banks took a far more active role. The phrase "too big to fail" became reality. Then came 2020. It started with whispers of a virus in China. Within weeks, global borders shut down, businesses closed, panic spread, not just in hospitals, but in the markets. Between February and March, the S&P 500 fell 34% in just over a month. It was the fastest crash in history. Markets hit the circuit breakers multiple times. Oil prices turned negative. Airlines, hotels, and retailers collapsed. But thanks to massive intervention from governments and central banks, the market recovered quickly, and then, incredibly, surged to all-time highs just months later. Now let's go back to 1997, the Asian financial crisis. It began in Thailand when the government couldn't support its currency anymore. The baht collapsed, and fear spread like wildfire across Asia. Indonesia, South Korea, Malaysia, their markets tumbled. Currencies lost half their value. Stocks followed. It was a brutal reminder that debt in foreign currency is a double-edged sword, that investor confidence can vanish overnight. In 1973, a very different kind of crisis unfolded. OPEC cut oil exports in response to Western support for Israel. The price of oil quadrupled. Gas lines stretched for miles. Inflation soared. Growth stopped. The stock market suffered a slow, grinding fall. The Dow dropped 45% over 2 years. But adjusted for inflation, the losses felt even deeper. It was the birth of stagflation, a nightmare combination of inflation and recession that policymakers struggled to contain. 2010 brought a crash unlike any other, the flash crash. Within minutes, the Dow lost nearly 1,000 points. $1 trillion in value disappeared, and then reappeared just as fast. No war, no virus. Just a rogue algorithm, high-frequency trading, and a lack of guardrails. It showed us how fragile modern markets could be when machines trade faster than humans can blink. In 2015, it was China's turn. Fueled by speculation and easy credit, the Chinese stock market doubled in less than a year. Then, in just a few weeks, it lost over 30%. Millions of retail investors, many of them new to trading, saw their savings wiped out. The government intervened, banning short selling and halting trading, but the damage was done. And finally, we returned to Europe in 2011. The Eurozone was cracking. Greece's debt crisis exposed a much deeper problem. What happens when you share a currency, but not a fiscal policy? Bond yields in Greece, Italy, and Portugal soared. Investors feared default. Stock markets across Europe tumbled. The euro's survival was questioned. Eventually, the European Central Bank stepped in, but trust had already eroded, and scars still remain. So what do all these crashes have in common? They weren't just about numbers. They were about belief and the loss of it, about fear overpowering logic, about systems stretched too far until they snapped. Markets always recover, but crashes are part of the cycle. Sharp reminders that risk is real, and history never stops repeating. These 10 crashes didn't just shake investors. They changed the rules, rewrote policies, and redefined generations. And the next time it happens, and it will, you well know it's not the first time the world has watched the market burn and rise again.